Next, let's look at the types of investments. Securities or property investments. A security is a certificate or other financial instrument that has monetary value and can be traded. Securities are generally classified as debt securities, such as bonds and debentures, equity securities, such as stocks, and derivative securities, such as options and futures. The sale of securities to investors is one of the primary ways that public companies receive new capital for operations. Property consists of investments in real property or tangible personal property. Real property refers to land, buildings, and that which is permanently affixed to the land. Tangible personal property includes items such as gold, artwork, antiques, and other collectibles. Direct or indirect investments. A direct investment means an investor directly acquires a claim on a security or property. If you buy common stocks of a company, such as Apple Incorporated, then you have made a direct investment and you are a part owner of that company. In contrary, an indirect investment means an investor owns an interest in a professionally managed collection of securities or properties. For example, when you purchase a mutual fund or unit trust, you are making indirect investments in the assets held by these managed funds. Debt, equity, or derivative securities investment. Debt is an investment in which the investor lends funds in exchange for periodic interest income and repayment of full amount of loan in future date. When companies or governments need to borrow money, they will issue bonds. Equity represents ongoing ownership in a business or property. The most common type of equity security is the common stock. Derivative securities are neither debt nor equity. Instead, they derive their value from an underlying security or asset. For example, stock options, low-risk or high-risk investments. Risk is the chance that actual investment returns will differ from those expected. For example, common stocks are generally considered more risky than bonds. High-risk investments provide much higher returns, but they also have the potential for much larger losses. That's why we say high risk, high return, low risk, low return. Short-term or long-term investments, which is the life of an investment. Short-term investments typically mature within 1 year, such as money market investments. Long-term investments are those with longer maturities, or like common stocks, with no maturity at all. Domestic or foreign investments. Most investments are domestic investments. That will be the debt, equity, and derivative securities of local-based companies and governments. However, investors also look for foreign investments, both direct and indirect investments, that might offer more attractive returns than purely domestic investments.